I was actually a junk bond trader, a corporate bond trader. So anybody that's familiar with Michael Milken and the shenanigans he got up to in the 1980s and 1990s trading some investment grade corporate bonds, that's what I did. And before we get started, I thought I'd just give you a brief outline as to why and how I came to become so interested in this topic. And really, it all started back in the crisis in 2008. I was working for a large Swiss bank, UBS. We'd just been bailed out by the Swiss government. We just lost 45 billion pounds on some mortgage-backed securities. And I realized that I didn't actually understand what was going on. I knew there was clearly something cataclysmic going on in the financial markets, but I didn't quite understand what it was. So that really started a journey for me to kind of understand the markets better. You know, I was clearly missing something, and that led me to an interest in money, but this didn't come until after I left the city. So, you know, much to my embarrassment and shame, I can say that for 20 years I was in the city and I absolutely had no idea how our money system worked. And what I can also tell you is that none of my colleagues knew. Everything I'm going to discuss today was never discussed with any of my friends, colleagues, managers. So I am very sure that the vast majority of people in the city, you will be better qualified to answer questions around how the UK money system works than probably 95% of people in the City of London, which is terrifying. Even now, when I meet some former colleagues and friends, we discuss it, and without fail, they answer incorrectly. They have no idea actually how these things work. I titled my presentation "The Big Lie" because I think that this is probably one of the most pernicious lies that we have in society at present. Both the left and the right, irrespective of political party, seems to be peddling this myth that central governments are somehow, or the UK central government is somehow financially constrained, and the reason why the NHS has insufficient funding, the reason why we can't do things like HS2, the reason why we can't do the Green New Deal is because we're somehow, as a country, financially constrained. And what I hope to do by the end of this presentation is convince you that it's actually a political choice. There are constraints, but the number one constraint, or the one constraint that we don't have, is the government's ability, the central government's ability to create money. So that's why I call it the big lie. And it really started back in 1979 with Margaret Thatcher. And I don't know if you guys can remember, but she said, there's no such thing as public money, there's only taxpayers' money. And that's actually 100% incorrect. There's only such a thing as public money, and there is no such thing as taxpayers' money, because all taxpayers' money is it's basically spending power that had been spent into existence by central government, being removed by central government. So it's absolutely backwards, but it was critical for her to kind of push her ideology through. And obviously the next quote I have here, I think sums it, is fairly self-explanatory. Make the lie big, make it simple, keep saying it, and eventually everybody will believe it. And I think that's very much the case now. I think the big lie is certainly the dominant narrative of people when people are thinking about central government spending. So I thought I'd start with a quote here. This is John Kenneth Galbraith. He was an economist at Harvard in the 1970s. And I hope to convince you that the study of money is very complex, but the process by which banks create money is so simple that the mind is repelled. So I will go through how banks create money. I'll go through how the central government creates money and how the commercial banking system creates money, which is slightly different, but it is very, very straightforward. So the presentation outline, we're going to start with the importance of framing. I will speak about the importance of monetary sovereignty, and then we will have a brief Q&A to make sure that everybody is on board there. We'll then move into the second section, which is the bulk of the presentation. So we'll talk about how money is created in a modern economy, how governments tax and spend, why do governments tax, are deficits good or bad, and even what are government deficits. We'll then have another Q&A, and then we'll move on to the final section of the presentation, which is the false choices we are offered, What are the constraints? Looking to the future and taking back control, and then we will end with another Q&A. So looking first at framing. So framing is important. You know, how we speak or how we're spoken to about things frames how we think about things. So when you hear things like deficits, debt, borrowing, debt burden, national credit card, that all frames how we think about money and how we think about government spending. Now, when discussing government spending, most politicians and media commentators, they usually frame things in a very particular way. So I've got some quotes here coming up. But, you know, they promote the idea that the government is constrained and is unable to provision itself with sufficient money to pay for the things that we want. We'll hear things like Liam Byrne, the former chancellor under the last Labour administration, left the infamous note, "Dear Chief Secretary, I'm afraid there's no money, kind regards and good luck." Or Theresa May, when she was speaking to a nurse in 2017, explaining why they couldn't have a real terms pay rise. She said there's no magic money tree. David Cameron in 2010, to kind of get people comfortable with the fact that we were about to see some significant austerity, tried to scare people with the more government borrows, the more it has to repay. The more it has to repay, the more lenders worry. And then he finishes with Greece stands as a warning of what happens to countries that lose their credibility. And of course, Greece is in a completely different situation to the UK. You know, Greece is embedded in the euro with all of the constraints that the euro imposes on those countries that are a part of it. The UK is absolutely not constrained in anywhere near the same way that countries in the eurozone are. And even our own Rishi Sunak here in 2020 said the government is not some entity that has its own money, which, I mean, frankly, should be retracted, because the government is the only entity that has its own money and that could certainly create debt-free money at will. So in terms of framing, I think, don't worry too much about the chart. I'm going to explain this chart in the second section, but really what I want to focus on here is how things are framed. So if you look at the question down on the bottom here on the political polls, do you support or oppose returning the country to a balanced budget? So this was asked in the States in April this year. 81% supported, 19% opposed. I suspect you would have something similar if you were to ask the same question here. Now, don't worry too much about what the chart represents, but I think I just want to point out a few things here. Number one, I think everybody can see that it's a mirror image. So the red line is government deficits, the blue line is the domestic private sector surplus, and the green line is the foreign sector balance. Don't worry too much about what those mean. All you need to realize here is that it's a mirror image. So these government deficits are to the pound and the penny, or in this case, the dollar and the cent, offset by the private sector surpluses and net imports or net exports. So if this red line was to go to the 0%, by accounting identity, this blue line must also come down and ultimately be negative, because there's not much that you can do with net exports in the short term. So you could just as well ask the same question would be, do you support or oppose returning or driving the domestic private sector into deficit? And I suspect that 81% would oppose that, if not more, but you're actually asking the same question. So framing is so important. And it's really important that we understand exactly how questions are being framed. But to do that, you actually need to understand properly the question that's being asked. So, you know, why we must change the framing. So I'm actually quoting here from a great book, Don't Think of an Elephant by George Lakoff. And, you know, he found that one of the fundamental findings of cognitive science is that people think in terms of frames and metaphors. The frames are actually in the synapses of our brain. And when the facts don't fit the frames are kept and the facts are ignored. So the problem that somebody like me faces is when I give a presentation like this and I can explain everything, when people have a certain frame and how they understand money, even when you present them with all of the evidence to actually how things work, most people are very resistant to that because it goes against their frame, which is why it is so important for us to try and change the framing. We need to change the frame of the debate, how people talk about money and how people think about money, because of course, you know, once your frame is accepted into discourse, everything you say is just common sense. because that's what common sense is. It's reasoning within a commonplace accepted frame. So the challenge for us all is to change the framing so for questions like this, do you support or oppose returning the country to a balanced budget? We actually say, do you support or oppose driving the private sector into a deficit, which I think most people would agree they wouldn't want to see. So on to monetary sovereignty. So this is a really important concept. And this is where, if you were to look at David Cameron's statement about Greece, Greece is not a monetary sovereign government or state, and you'll see why in a minute. So to be monetarily sovereign, and everything that follows in this presentation assumes monetary sovereignty, the UK government, or the UK does have monetary sovereignty because it satisfies these four main conditions. It issues its own currency, it collects taxes in that same currency, it only issues bonds or gilts or any type of debt denominated in that currency. So this is where obviously Greece is not an issue, is not, Greece does not issue its own currency. And it also operates under a flexible exchange rate regime. So we satisfy all four of these main conditions. We are monetarily sovereign. And there's only a handful of countries that actually have this full monetary sovereignty. So you obviously got the United States, you've got ourselves, Japan, China, Australia, and Canada are some of the larger countries. And like I mentioned, one of the major weaknesses in the Eurozone is that countries in the monetary union individually do not satisfy these conditions. So nothing that I'm going to talk about now can apply to any European country. So now on to who has monetary sovereignty. And this is the kind of what state actors or what actors in the economy have monetary sovereignty. Well, not us or any other private citizen. We can't create our own money. We could try, but you get sent to jail. We don't issue debt. No, we don't satisfy any of those conditions. So not us. Obviously not any business, because business is in the same boat. Not local authorities, because local authorities are obviously dependent on local taxes or from central government funding. And the only entity that has monetary sovereignty is the entity that has the sole power to create debt-free money, and that is the central government. So this is the same central government that Rishi Sunak said didn't have any money, when they're actually the only actor that actually has the power to create their own money. So yeah, that is the same central government that everybody insists, in fact, has no money. So even from this starting point, I think you can start to ask some really interesting questions when you hear politicians say certain things, particularly central government politicians. So it's really crucial that we distinguish between currency issuers, and there's only one, which is the central government, in our case in the UK, and currency users, everybody else. So this is where I think you get the biggest problem, because currency users, i.e. the voting public, tend to think of the central government in the same terms as they see themselves. We have a household budget, we have incomings and outgoings, we have a certain amount of revenue. It's completely different from a currency issuer perspective, and I'll go through how it works in later slides. So I just wanted to pause briefly here to make sure that everybody was still comfortable, or if anybody had any questions before I move on.
Yeah, hi, hello, it's Mark Scott here. Hi. Turn the video. Yes, I had a question. What is the nature of money? Are you going to cover that, Vince? Or because a lot of people think that money is still something that is in effect backed by assets.
I had that very question. I had that discussion with somebody recently that still thought that it was that the pound was backed by gold.
Yeah.
I think there's some fascinating, maybe I do another one. There's that I've got, we can talk about tally sticks. We can talk about some of the revolutionary currencies that were in circulation in America in the 1700s around the time of the war. But no, I don't specifically touch on that. What I'm looking to do here is really go through the mechanisms of how central governments create money and how commercial banks create money. But that's interesting. I think it would be good to have another presentation on something like that, on the nature of money.
But Vince, I guess we could say very, very simply that whereas if you go back 100 years, the UK currency was backed by gold, we haven't actually had any backing for our currency since 1971, I think it is. So the technical phrase for our currency system is a fiat currency, which means effectively that the government simply says, let it be, That's what fiat means. And money comes into existence, and it has value because the government says it has value, not because of any assets backing it.
Absolutely. You know, if you look at a £10 note, it promises, the Bank of England promises to pay you £10. So you can take your £10 note into the Bank of England and say, I want my £10, and they'll give you another £10 note. So it's not backed by anything. You know, up until 1971, it was tied to gold, well, tied via the US dollar to gold. But since then, it's been free floating. But yeah, maybe we talk later, and maybe I could put something together. I've been thinking about it, actually, putting together something, because I think there's a really interesting history around money and you know, how we got from A to B to where we are today.
Does that give you enough for now, Mark?
Yeah, I mean, it was just an observation that other people that talk along the sort of same lines as I expect Vince is going to talk us through do make a point of mentioning the whole fiat currency thing and the fact that money is little more than a promise.
Absolutely.
Yes.
Yeah. Which in fact all money is generally. It's a promise to do, you know, you're either promised additional paper, you're promised gold. It's served a variety of different purposes. Silver, you know, there's lots of different ways, but it is always basically, you know, boils down to a promise. Does anybody have any other questions?
Can I just ask this business of the framing and you know, I've been listening to this stuff from governments for 40, 50 years. Why is it we get the same message from every government, Labour, Conservative, whatever it might be? Why is it we get the same message? Is it because they do not understand, like 95% of the people you mentioned don't understand how money works? Is it because they don't understand, or is it simply because they do understand, but they want us to keep us within the framework?
I think it's both. I think it depends. I've spoken to a number of politicians, current and former, and I think the level of ignorance is quite high, frankly. In fact, I think Positive Money did a study a few years ago, and there was a shockingly high number. It was in the 70% for Conservatives and in the 80% for Labour MPs that actually understood how commercial banking worked. You know, never mind, you know, central governments, which I found, you know, very surprising. But I think it's a bit of both. You know, I think, and I actually have a great quote towards the end as to why I think we've ended up in this situation. I think a lot of it is fear. I think a lot of it is fear. The government fears that if we really understood how it worked, we would make far larger demands on them. You know, it's very easy at the moment for governments to say we haven't got the money, and people can kind of understand they haven't got the money because they view central government finances as they would a household, and it basically makes their job easier. Because if we really, you know, push the point, I mean, I would be asking the government, you know, I know that you can create the money, but tell me what are the physical constraints? You know, in terms of something like the NHS, do we have enough nurses? Do we have the doctors? Do we have the hospitals? Do we have all of the infrastructure that we need to treat our people? The money is not a problem, and I'll be speaking a bit more about that in the second and third section. Actually, I'll be talking a lot about that as to why I think we've ended up in this situation.
And there are a couple of people with their hands up. JW has put two questions into the chat. The first one is, why is the private sector profit the same as public deficit, which I think you're going to come on to in more detail in the next session.
Lots of detail on that. Yeah, that's
so perhaps we'll skip that one for now. And his second question is, I believe the dollar is not tied to an exchange rate because debt is issued in dollars. Is that right?
Not really. That's not I mean, the dollar is free floating, and it has been since 1971. I don't think it's because the debt is issued in dollars as such. I mean, you could take something like Argentina had an exchange rate that was also subject to massive fluctuations, and it actually issued a lot of its debt in dollars. So no, I don't think that's. I think it's more a choice by the U.S. government. You know, the U.S. government, if they wanted to, they could say we're going to tie it to a currency, we're going to tie it to a commodity, but then they would need the financial resources to then maintain that exchange rate. And nobody wants to do it. You know, the UK tried it in the 1990s with the exchange rate mechanism. It can be, you know, ruinously costly to do something like that in terms of foreign exchange reserves. Because of course the problem is, if you tie it to anything, you then need that other thing. You know, if you're a fiat currency and you're a free floating currency, all you need is your own currency. You know, it's not tied to anything. If the pound was tied to the dollar, then we would need dollars to maintain that exchange rate. And the Bank of England can't create dollars. So we would need to find those dollars from somewhere. And that's where the problem comes. That's why it's far easier, and why it's actually crucial, if you want to claim monetary sovereignty, that you don't have those constraints, because that is a major constraint. You know, you cannot create money with the same, with the same consideration that if it's actually tied to something beyond your control.
And then I think Tony was next, and then Howard, I think.
Yes. Hello, I don't think you see me. No, I was talking to a friend of mine who teaches economics, who pointed me to the Treasury website and showed that actually the money that was acquired, the 500 billion for the financial crash, didn't actually wasn't a result of debt or bonds, so that was purely created out of nothing.
Yeah.
And he said basically there's there's not one magic money tree, there's three magic money trees. There's quantitative easing, and there's private banks money creation, and the ability for the Treasury to run an overdraft.
Yeah, you've actually stolen some of my thunder, because we've got the video coming up with Ben Bernanke,
Right.
how from the horse's mouth, how how the bank bailouts took place. But
Right,
no,
so
you're right.
Then Howard, I think, was next.
Yeah, thanks, Mark. Hi, Vince. So the question I've got is around as governments spend and deficits are created, and those deficits accumulate basically year on year on year, the government ends up on its balance sheet as having a negative net worth of an increasingly large amount, which to sort of the layman is a terrifying prospect, because negative net worth just feels like the worst thing that you could possibly ever imagine. But how should we look at that negative number on the government's balance sheet? Because from a framing perspective, you could say that's a very positive thing, because that's the investment that the government is making into the country. You know, you could look at it that way. So how should we think about that increasingly large negative net worth?
Well, I mean, the UK does have a negative net worth. Not all countries have it. I think we are the second largest negative net worth country after Portugal, because we basically sold off most of the state assets. But the thing to remember is that the negative balance with the government is balanced against. I mean, the UK government basically has at its disposal, in perpetuity, the entire productive capacity of this country forever. You know, that is what it's backed with. It's backed with the perpetual productive capacity of the UK. So it's not a point in time. It's not, this year's deficit. The government will, we assume, will have tax raising powers in perpetuity. The government will have, a call on the resources of the people and the natural resources and everything else that we have here in perpetuity. Everything that we build, I think that we should be publishing, I think the Conservatives should have done it, but they haven't done it yet. But, we talk about debts and deficits. We talk a lot about cash flow statements effectively and profit and loss accounts, but we never talk about balance sheets. And what the government should be doing, and they were supposed to do this last year, and I think they're very late in doing it this year, but publishing a balance sheet. So you can say, okay, we've got this negative stock of money, which we basically created these tokens and put them into the economy. But we have this massive balance sheet, and that's just the physical assets. But, of course, another way to look at it is in perpetuity, we've got, the entire productive capacity of the United Kingdom, which is way bigger than the national debt, by the way, I would wager, to actually think about it.
Yeah, I mean, it's myopic, isn't it? Just looking at one number and calling that, again, it's a political framing.
Completely. I think it would, if we can start publishing national net worth, I think that will really start to help as well. Because I think people just, how can you talk about spending without talking about what am I getting from my spending? If you've got assets going onto the balance sheet, we only seem to talk about the negative.
Yeah, thanks.
There are a couple of comments in the chat. Mark Scott has mentioned that the US dollar is the reserve currency. Andy McGregor's pointed out that it's easier to say we haven't got the money than to explain to us that they simply don't want to do something. And Aid has quoted Malcolm Reevell saying that national debt isn't really a debt. It's a cumulative record of the government money created to date, but not yet recovered.
Absolutely. Yeah, and I think that's a really important point as well. That the government could, if they wanted to, eliminate the national debt by just taxing all of the money that they'd put in and not tax back at once. But I imagine that's not a vote winner, and it would also, of course, destroy the economy. So
they could also eliminate it simply by creating new money to the value of the national debt.
Yeah, of course. We are now on to how is money created in the modern economy. So there's only two ways that money can be created in a modern fiat economy. Keystrokes by the Bank of England into private bank reserve accounts on behalf of central government, or keystrokes by private banks that create deposits when people or companies borrow. There's no other way for money to be created. It's either created by central government or it's lent into existence by commercial banks. So here we've got the UK money supply. So you can see, so this is the M4 money supply. So this is basically all deposits, and notes and coins. So we've got about £3 trillion at the moment, which is a UK money supply. And I like this chart. You can see some interesting charts. You can see some interesting dynamics here. You can see the financial crisis. We've got the financial crisis here where we had the money supply went to a shuddering stop there. Then we had the first quantitative easing. You can see here we've had, this is austerity. And then we can see the COVID bounce here, and you can see where we are, about £3 trillion. So I like this because you can kind of, you can relive history through the UK money supply chart. So this is Ben Bernanke. So he was a former chairman of the Federal Reserve, and he here is talking about whether taxpayers' money was used for the bank bailouts in 2008.
Balance sheet. Is that tax money that the Fed is spending? It's not tax money. The banks have accounts with the Fed much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed. So it's much more akin, although not exactly the same, but it's much more akin to printing money than it is to borrowing.
You've been printing money.
Well, effectively, and we need to do that because our economy is very weak and inflation is very low.
So there you go. So that was the bank bailout in 2008. So it was not taxpayers' money. It was keystrokes by the central bank into the reserve accounts of the commercial banking system. And that is what prevented a catastrophic collapse in the UK economy. This next one is interesting. So this is Alan Greenspan. So he was the chairman of the Federal Reserve prior to Ben Bernanke. And I think it's worth listening to in its entirety because he really, so he's being questioned by a chap called Paul Ryan, who is far to the right in American politics. And he was really trying to get Alan Greenspan to say that the Social Security system in America was unaffordable and that there needed to be significant cuts to the benefits. And you'll be able to, he does everything he can to try and get Alan Greenspan into a corner. But Alan Greenspan, to his credit, actually does tell it how it is. And you can see from the title here, there is nothing to prevent the government from creating as much money as it wants. So that should give you an idea of what he's going to say.
Having personal retirement accounts is another way of making a future retiree benefits more secure for their retirement. And also, do you believe that personal retirement accounts as a component to a system of solvency does help improve solvency? Because when you have a personal retirement account policy, it's accompanied with a benefit offset. With that feature in place, do you believe that personal retirement accounts can help us achieve solvency for the system and make those future retiree benefits more secure?
Well, I wouldn't say that the pay-as-you-go benefits are insecure in the sense that there's nothing to prevent the federal government from creating as much money as it wants and giving it to somebody. The question is, how do you set up a system which assures that the real assets are created, which those benefits are employed to purchase? So it's not a question of security. It's a question of the structure of a financial system which assures that the real resources created for retirement, as distinct from the cash itself is nice to have, but it's got to be in the context of the real resources being created at the time those benefits are paid, so that you can purchase real resources with the benefits, which of course are cash.
Mm-hmm.
He didn't like that. That wasn't the answer that he was hoping for. But I think ignoring the kind of shenanigans that Paul Ryan was trying to pull, I think what was really interesting about what Alan Greenspan said there is, first of all, he acknowledges that the government can create as much money as required at will. And the constraint, which I'm going to talk about at the end of the presentation, is really the real resources. The government can create as much money as it wants, but is that money going to be able to purchase the goods and services that society demands at the time that money is created? So really what we should be talking about is, do we have the productive capacity in the economy to provide the goods and services that the country needs? Not the money, but we seem without fail to stop at the money. We never get on to the second question, which is what productive capacity. We have an aging population. Are we structuring our economy with the goods and services and infrastructure necessary? The money is not the issue, but I've yet to see a single article anywhere of note that actually starts to talk about these resource issues as opposed to the money issues. So even the Bundesbank agrees. So, I mean, by this point, I could pretty much stop my presentation, because you've heard from two chairmen of the Federal Reserve, and you're now about to hear from the chairman of the Bundesbank, who in a speech, this is Jens Wiedmann, in 2012, said central banks create money by granting commercial banks credit against collateral. The financial power of a central bank is unlimited in principle. It does not have to acquire beforehand the money it lends, i.e. through taxation, but can basically create it out of thin air. So, the printing of money is an appropriate image here. From an economic perspective, the printing press is not necessary. So, I think at this point, it should be indisputable that the central government does have the power to create money. So going back to Rishi Sunak's earlier comment that the government doesn't have money, I think, really should be called out. So that was central banks. So central banks can create money at will. Monetarily sovereign countries governments can create money at will. So how do commercial banks create money? So going back to the J.K. Galbraith book before, it really is quite straightforward. But there's often quite a few misconceptions here. A lot of people think that banks simply act as intermediaries, that they take in deposits and then they lend those deposits out. So they take in deposits at 2% and they lend them out at 3%. And that's how that's their kind of business model, which is completely wrong. Banks are in no way dependent on deposits generally. There are many other constraints, and much different constraints that regulate them in terms of how much money they can create. So this is from, so the Bank of England, believe it or not, this piece here, the Bank of England 2014 Q1 quarterly bulletin, was the first time in history that the Bank of England actually published a piece explaining to people how the commercial banking system worked. So prior to 2014, there was no literature anywhere published by the Bank of England that told anybody about how the commercial banking system worked. But here, this is where they let the cat out of the bag, where, you know, whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. So it's not lending out deposits. That would be far too restricted. So the way that the commercial banks actually work is all they have to do is identify a creditworthy borrower. And then they will then credit that creditworthy borrower's account. They will take that loan note as an asset. So the borrower now has spending power. He's got a deposit, which is not the same as central bank money. They have a bank deposit, as people in Northern Rock found out in 2009, whatever it was. And that's how the commercial banks actually create money. So it's not limited to deposits in any way. And in fact, 97% of all that 3 trillion that we saw before is actually bank deposits. And that's specifically broad money. There's lots of different types of money, but I'm talking about broad money here. And of that, in a modern economy, those bank deposits are mostly created by commercial banks through lending. So the vast majority of that 3 trillion is actually debt. It's commercial banks having lent money out to corporations, consumer credit, predominantly mortgages, as you can imagine. So that is where a lot of the deposits are created, generally asset-backed. So of course, a corollary to that is if the commercial banks create money, in theory, the money created by lending is destroyed when the loan is repaid. So that's another really interesting thing to remember. So when governments tax, they remove spending power from the economy, and that is effectively money destruction. And when somebody pays back a bank loan, that is also money destruction. So that's where you will see the 3 trillion line start to come down. But in practice, generally, the banks are always lending more than is being destroyed, and therefore the money supply does generally tend to increase. So what about government spending? So we're going to talk now briefly about government spending. And the first thing I think I really want to highlight is the government has no need to provision itself in order to spend. As the chairman of the Bundesbank mentioned, the central government does not need anybody's money. That is, it has no need of taxpayers' money, of which there's not really any such thing as taxpayers' money. It's just an accounting entry, which I'll show you the accounts later on. Secondly, some people think that the Bank of England is independent, and while it is operationally independent, it's not functionally independent. The Bank of England has no choice but to grant the issue of account for credit. So whenever the government has a legitimate claim, a legitimate expenditure claim, the Bank of England must honor that. They must credit the commercial banks with the appropriate reserves as authorized by specific acts of Parliament. So the Bank of England is operationally independent. They have they can manage monetary policy independently, but for all intents and purposes, again, as I'll show you on another slide, they are 100% owned by the government. And to give you an idea of how quickly we can create money, I actually had a look into this. I had a look at the somebody put a Freedom of Information Act request in, and I had a chance to look at the actual notes that went through for this particular session in 2020, when the government realized that there was a chance of a lockdown and it needed to provision itself, given the massive uncertainty. So at the beginning of March, they decided that they needed 120 billion pounds. So they went to the House of Parliament. The appropriate acts were referenced, and it was voted on, and 120 billion was created. So effectively, the money supply had gone up once it was spent into the economy by 120 billion, by nothing more than a show of hands. That was all it was. There was no 120 billion in a taxpayer's account anywhere. There's no rainy day fund. It was voted into existence, just like we see after the budget. just like we've seen several times, particularly during the various crises that we've had. I've got a couple of charts here. I'm not going to dwell too much on them, but I thought it would be instructive to just briefly show you how things actually work, and where the various boxes sit. So here you've got the public sector. We've got all the various different government banking services, debt management office, and here you have the private sector. So this is businesses, households, and non-bank financials, and then we also have the commercial banking sector here. At the intersection here, we've got the Bank of England. And a good way to think about the Bank of England is it's basically the interface between the state and us, which makes things like the digital pound. I don't know if anybody's following the debate there, but I've been following that quite closely. And what really excites me about that is that actually gives us here in the household bubble here a direct conduit into the Bank of England, and we'll be able to hold digital wallets, directly linked to the Bank of England, but bypassing the commercial banking sector. But I think one thing to note here, you've got the Bank of England here, which is basically the interface between the two. The key kind of mechanism is the government works via the Bank of England, works via the commercial banking sector, which is then responsible for distributing and managing deposits for the rest of the economy. To go into a little bit more detail, don't be frightened. This is a slightly more detailed diagram to where you can see some of the funds. I'll have this presentation available so you can look at this at your leisure. But you can see some of the funds here. So you've got the state central government here, you've got the Bank of England here, and here you've got the private banks, and here you have us effectively here. And that's the kind of flow of money. So if you were looking at something like your national insurance, this is your HMRC account, you can see the flows into the reserve accounts. And basically all of the different government departments have reserve, well, not all of them, but there's certain of the government departments have reserve accounts at the Bank of England, and that's how they interact with the reserve accounts of the commercial banks, which then allow us to access any government funds, or indeed to pay the government funds. Your taxation goes via Barclays into the reserve account, and then into the HMRC account, for example, and that's where your tax money goes. It's destroyed. There's no kind of taxpayer's account. It's just, the opposite side of the ledger, and it's basically removed from the private sector. A quick follow-up on the Bank of England. The Bank of England has been wholly owned by the government since 1946. It was national. Prior to that, it was private. In 1998, it was made operationally independent, but by law, it must make good any payment the government instructs. So for all intents and purposes, it's not really independent. I think really that the whole idea of Bank of England independence is just a cover for the government, because it can basically allow them to throw their hands up and say it's nothing to do with us. The Bank of England is independent, but the government can appoint the governor of the Bank of England. They can appoint the board members of the Bank of England. 100% owned by the government. So, for all intents and purposes, it's a state entity. And, the fact that it is the Bank of England is owned by the government has its own bank, and this matters. The government is not like us. Politicians and economists, they tend to pretend that the central government must first borrow or raise taxes to fund spending. But this really isn't the case, because government spending always comes first. And maybe on another presentation, I can take you through the kind of accounting entries. But when you understand, if you take the COVID, for example, the 120 billion, that was actually spent into existence. There was no offsetting tax balance anywhere. There's no taxpayers' account anywhere. So the idea that governments must borrow is a complete nonsense. There are certain constraints that the government has imposed upon itself that necessitate the issuance of these gilt securities, but it is absolutely a self-imposed constraint, and I think, like Howard was saying, it's because it can't be negative. Basically, that the bank cannot have a negative balance on its reserve account at the Bank of England, so the offsetting balance is the issuance of gilts, but it's completely self-imposed. There's absolutely no need for it. So, and really a question I would ask is to anybody that questions this logic is, why would the government need to borrow something that it can create at will? The government can vote money into existence. It does every year with the budget, it did with COVID, why would it need to extract money from the private sector to provision itself for spending? It can always vote into existence any amount of money it chooses to. So I think, I did see a question on the hyperinflation. I'm going to come to that because that inevitably is where people they go directly from, if governments can create money, then there's do not pass go straight to Weimar, but that's not actually the case either. Now, of course, when you understand this, there are very real consequences to consider when if you do acknowledge that governments can do this, which you should, and obviously with great power comes great responsibility. So just to recap, the UK government is the monopoly issuer of pounds, and the government spends by instructing its bank, which is the Bank of England, to mark up the bank account of the private sector seller of goods or services. If they're going to pay a nurse, a doctor, defense contractor, whatever they're doing, they basically pay into the commercial bank, which then makes those funds available via deposits to the ultimate private sector seller. That's how the government gets money from them to us. It does not need to borrow from the private sector to do this. And if you think about it, it's actually physically impossible to do so. As a thought experiment, if you think about it, and if we can agree that the Bank of England is the sole creator of debt-free money, the national debt is nothing more than all of the deficits added together. But how can you borrow from the private sector something that they can't create? Businesses can't create money. People can't create money. So how can you borrow something that you didn't in fact create? And if you indeed created it and you can't create it at will, why would you need to borrow it from anybody? It's actually impossible for them to do so. So, to finish up here, we can show that the government does not maintain balances from which expenditure is sourced, which is basically saying that there is no taxpayer's account. There is no need for taxpayers' money. There are very many good reasons why we need to tax, which I'm going to come on to. But provisioning the government, which is the main one that people seem to have in their heads, is actually completely false. But there are some very good reasons as to why we would need to do that. If governments don't need to tax people to provision themselves, what are central government taxes for? And there's some very, very good reasons why. The first one is to create demand for government currency. If the government imposes a tax on people and you can only pay that in pounds, you're going to need pounds. You're going to need to get pounds from somewhere. You're going to need to work for pounds. You're going to need to do something to get those pounds to pay the government. So this is the kind of first level of the first kind of level of reasoning for why or what central government taxes are for. And this is actually a lot clearer if you look at things like tally sticks and you look at some of the revolutionary currencies in America. It's much easier to understand. But that's number one. Number two, and I think today is the biggest one, which is to help guard against inflation. Now, for those people that think, well, if we acknowledge that central governments can create money at will, doesn't that immediately lead to hyperinflation? I would say that's nonsense because, of course, you can, any government can create at will, but to prevent there being too much money in the economy for the available productive capacity of that economy, that's what taxes are for. But what we don't need taxes for is to provision the spending in the first place. So taxes should be viewed more as a balancing mechanism. And we could actually be far more inventive with taxation. If people are willing to understand how it works, we could be far more inventive to make sure that we're removing those spending tokens from the area that it needs to be removed from, as opposed to this idea that, we want to spend more here, so we're going to take some from here, because that doesn't make any sense. Another reason is to alter the distribution of income, which many countries do, and which I think is very important. Also very important is to incentivize or disincentivize certain behaviors, tobacco taxes, alcohol taxes, carbon taxes, and also in some instances to isolate certain programs such as Social Security. So those are the main reasons for central government taxation. Notice none of them are to provision the government with spending. The government needs to tax so that they can spend. That is absolutely 100% not necessary. Like I said, the primary one is to help guard against inflation. And you know, what's really sad is we've known this for a long time. And I came across this when I was putting the presentation together. And this was written by another chairman of the Federal Reserve, but this is back in 1946. And what I want to draw your attention to is this couple of paragraphs here in italics. You know, the necessity for a government to tax in order to maintain both its independence and its solvency is true for state and local governments, which is very true here in the UK as well, but it is not true for national governments. Two of the greatest consequences have occurred in the last 25 years. The first of these is changes in the gaining of vast new experience, which in the intervening years, we have even more experience. But the second change is the elimination for domestic purposes of the convertibility of the currency into gold, which also, you know, we've been in that situation, certainly, you know, since 1971. So none of this should be, you know, when I was reading some of this, I thought, why are we still having the same conversation? You know, this should be very well known. It's very well established. But somehow, you know, we still seem to get the, you know, the wool pulled over our eyes. I came across this quote. This was written by an economist at the St. Louis Federal Reserve. And I thought this was interesting because it's coming from the Federal Reserve. And he found that the consideration suggests that we might want to look at the national debt from a different perspective. And particularly, it seems more accurate to view the national debt less as a form of debt and more as a form of money in circulation, which of course it is. You know, when you understand money and you understand how central governments create money, you understand how the flow from the accounts from central government into the private sector goes, you understand that of course it is a form of money in circulation. But, you know, for the orthodox economists at places like the Federal Reserve, I thought it was fantastic to see some sort of recognition there as well, or the beginnings of a recognition. So now we're going to go back to this chart, and I'm going to go into a little more detail as to what this actually means. So looking at the chart here, you can obviously see that it's a mirror image. The red lines are the government deficits. All of these added together is equal to the US national debt, going back to 1914, I think it was. But if you add all of those deficits together, you get the US national debt. You can do the same with the UK government as well. The blue is the surplus, which is the private sector, domestic private sector balance. So in this domestic private, what's really important here is to understand that you have households, you have the financial sector, and you have the corporate sector. So there are three actors in these blue bars, and it's really important as to, you know, where are the surpluses and the deficits. So you could have like a massive financial sector surplus, and you could have a negative consumer sector. You know, the consumers could be in deficit. So I haven't broken it out here. I thought it would just get really complicated then. But that's what we have here. And the green lines are the nets, the net exports. So here, anything above the zero line, the country is importing, and anything below the line, you could see that the US used to be an exporter. You know, back in the day when it had a significant manufacturing capacity, and soon after the WTO and globalization soon became a big net importer. So this is what's known as the sectoral balances chart. So I did that for the UK. So I went to the Office of National Statistics, I downloaded their spreadsheets, and I put together the chart, and reassuringly, it looks very similar. So we have the same kind of mirror image here to give you an idea of what it looks like for the UK. So we can see here that the UK for this period, this goes back to 1987, has consistently been a net importer, which is not really a surprise. Other interesting things to note here, we can see that pretty significantly that the UK has been running a deficit. And here you can see that for a brief period, and actually if you go back here, for a brief period around the same time in the late 1990s, there were surpluses in the US and the UK. But of course, the cost of that surplus, you can see here, the government was actually in surplus. We had which the private sector was in deficit. And really, when you understand the accounting identity here, if this red line goes to zero, that blue line is going to be negative. There's no other alternative. So if any politician says, you know, I'm going to get the deficit down, the question has to be, what part of the private sector surplus are you going to send into deficit or deplete? Because one of either the financial sector, the corporate sector, the household sector, by accounting identity, must deplete to compensate for that. There's no other alternative. So this is the UK sectoral balance. And what I'm going to do now, which I did do I showed on the last presentation, but what I'm going to do now is I'm going to go through a couple of other countries just to give you an idea of how things look globally. So, the government's deficit is the private sector surplus. That's really the key takeaway here. And of course, the government deficit is simply untaxed government spending, as we mentioned before. So this is a chart of 39 advanced economies from 2000 to 2020, and this is from the IMF. And you can see here, it doesn't, we can see here that government deficits are the norm. So again, anybody that tries to convince you that the UK is somehow anomalous in how we run our economy here with deficits, and if we did it differently, that things would be different. If you look here, it's clear that the standard position for the sectoral balances across these economies, the government runs a deficit and the private sector runs a surplus. That's how it is. That's how it's been. Nothing to be afraid of. So I'm going to go through a couple of countries here. So this is again the US. We can see the US, and I think what's interesting here is if you look at what happened in the kind of 2000s, this was the subprime mortgage. This was the massive increase in auto loans, in credit card debt. When the government ceases to spend and you drive the private sector into a deficit, in this instance, it was the consumer that was the problem. So like I mentioned, it could be households, it could be corporations, or it could be the financial sector. It was predominantly the financial sector and corporates here. And then, of course, we had the great financial crisis in 2008. And then, we're back to the normal situation where governments are running significant deficits, which then allow the private sector to run significant surpluses, and we started to get our way out of it. So, sustained private sector deficits are unsustainable. They will generally lead to some sort of a financial crisis. So I'll show you a couple of other countries that private sector deficits are very rare indeed. So this is China, and you can see, what's interesting here. What has China decided to do? Number one, they've ensured that their private sector is always running a surplus. Now, what they've been able to do, because they've obviously, a manufacturing powerhouse, is they've been able to get away with far less government deficits, and they've basically been allowed or able to do that by their export sector. So we don't have that luxury, given that we're net importers, and frankly, for the foreseeable future, we're likely to continue to be so. So that's not an option open to us. But that is what China has opted to do. If you look here in Japan, Japan's an interesting one. Japan had a financial crisis back in the late 80s, early 90s. I think the Nikkei is still not as high as it was back then. So it's generations, decades lost. But you can see here a similar situation where you had a cutting of government deficits, eventually a very brief period for a few years where the government was in surplus, which eliminated private sector savings, and they had their crisis right about here. And now, ever since then, they've run significant. And I think one thing to note here is if you look at the scale here, we're looking at 10% deficits, 8 to 10%. People panic here when we start talking 4, 5, 6%. Japan has been running those types of deficits for decades. So again, it begs the question, how frightened should we be of deficits? But I think it was interesting to show you here what happens. Australia. So we can see here, Australia basically has run negative private sector balances for a number of years. So the question is, what are the consequences of that? And that's purely through insufficient government spending. If they opted to run larger government deficits, then by accounting identity, these blue lines would not be below the zero, they would be above the zero. So what actually ended up happening in Australia is you saw an explosion in household debt. So when I mentioned before, if you have insufficient government spending, it must be transferred onto some part of the economy. In the case of Australia, we can see that it was mainly transferred onto the household sector. Japan opted not to do that with their 10% deficits, as you can see. They weren't forcing, in fact, they were doing the opposite, and it allowed household debt to decrease. America did the same post financial crisis, having insisted on running insufficient deficits up until that point. We had the subprime, we had credit card debt, and we had the various mortgage debacles there. So if the deficits are insufficient, the key takeaway, if government deficits are insufficient, they will be transferred to another part of the economy. There's no getting away from it. There's no free lunch anywhere. And the question that we have to ask ourselves is where is that going to show up? I would argue the worst place is in the household sector, because that is, given that consumer spending is such a large part of our economy, the last thing you want to do is make the household sector more financially fragile. A brief look at the national debt. So this is a chart of the national debt or the UK national debt going back to, as a percentage of GDP, going back to 1900. So at the moment, we're told that we've got no money, we can't have any infrastructure spending, we can't rebuild crumbling schools, got no money for the NHS. You can see we're running at about 100%. And in fact, this number is probably overstated because a lot of debt is owned by the Bank of England, which is actually the government owning it, owing debt to itself. But because of the fiction of the independence of the Bank of England, they're allowed to actually scare people with a much larger number. But you can see we're running at about 100% debt to GDP. But back in wartime, you can see that it was significantly higher than that. And so, frankly, where we are now is in my view, nothing to be too concerned about. So I guess what is the national debt? And I think I mentioned a couple of times that the national debt is nothing more than the sum of the previous deficits, which is nothing more than untaxed government spending. And what may surprise some people is, if you look at something like national savings and investment, that's national debt. So at the moment, you've got £207 billion, which is currently invested with the national savings and investments across 25 million customers. So that £207 billion is counted in the national debt, the 1.8 trillion or whatever, roughly, that we have in national debt. And if you go to the website, it says when customers invest in NS&I products, they're lending to the government. Now, of course, that's your choice as an investor. People like to have that option. But actually what you're doing is you're increasing the national debt. So everybody that invests in national savings and investment, you're actually making the problem worse. You're increasing this debt problem, which is of course ridiculous. And I think when you start to think about that and say, well, hang on a minute, if that's a national debt, that's actually my personal savings. And I think that's where maybe you'll get some light bulbs going off and saying, well, hang on a minute. So the mirror image of this scary national debt number is actually private sector savings, which goes back to that chart before where we were showing the sectoral balances. And the national debt is nothing more than private sector savings. Now, of course, where is that? Who owns it? How is it distributed? Like, these are all very interesting questions. But I think if we just take a step back and think about what the national debt is, it's nothing more than private sector savings. We've also got another £390 billion in government debt in pension schemes. So, 600 billion of our national debt is actually directly related to our savings, and we can point to them right here. So should we be afraid of that? So if we're going to have larger pension funds, by definition, they're going to need government debt. They're going to need more debt. Where are they going to get that from? So, it's kind of very difficult for you to argue on the one hand that you want to decrease national debt, and at the same time, you argue that you want to increase private sector savings, because you simply can't do that. So, this is really important. And I think these two examples I thought illustrate beautifully, how debt is just, one person's debt is somebody else's asset. If you have a mortgage, that's an asset of the commercial bank. So there's always the asset holder on the other side that owns that loan note for, who actually owns it or holds the asset. So the national debt is the private sector savings. It is, even if we just restrict it here to the 600 billion. And savings are good. So is the national debt bad? If savings are good, they're the same thing. So again, it comes down to framing. And I would argue that there really is not that much to be concerned about. So questions that I often have, and I think I've seen one or two in the chat now, is, well, if we recognize this and we agree that this is actually that we agree that this is all factually correct, aren't we going to have a currency collapse? And really the way most people tend to think is, if the establishment admits that we can create money, that's then going to directly lead to unfettered money creation. That's going to then directly, do not stop, stop it, go and collect £200. We're going to go straight to hyperinflation, which is then going to lead to a collapse in the currency and the economy. And, I would argue, that that's nonsense. Nothing will change with the admission. And in fact, it doesn't really matter, because this is how it works. Whether we acknowledge it or not, this is how it works. Money creation will still be governed by the same laws that have always applied. And in fact, we have, as I discussed previously, inflation, which is absolutely key here, which will need to be closely monitored. Now, we already do that. We have the 2% rule. So we have institutions there that are monitoring inflation. So, this idea that if we admit money creation, that we're gonna have problems is nonsense, because, I would argue that the current toolbox that the Bank of England has is inappropriate, but maybe that's something for another presentation. But we have the tools in place to monitor these things. So, unfettered money creation, when we get to 2 or 3 or 4%, then the Bank of England would raise interest rates. And in fact, I would argue it would be far more realistic for them to do that, or right for them to do that, because that would be as a direct consequence of money creation, which is precisely when you should be raising domestic interest rates. Should you be raising domestic interest rates because of, factors outside of that country's control? Probably not. War in Ukraine or logistical issues that are outside of your control. But certainly from a money creation perspective, interest rates are absolutely the right tool to use, because that's directly targeted at the domestic money supply, which is what we're talking about here. So what will change, of course, is that politicians of all stripes will now have to justify why they are enacting or not enacting the laws that they do. So I think that would be, one of the key changes that we would see. And, they would no longer be able to hide their ideological beliefs behind phrases such as hard choices, tough decisions, on the grounds of insufficient central government spending power.
There were 3 questions. Is the Bank of England really independent?
Yeah.
Why does a public sector deficit mirror a private sector surplus, and vice versa? And the third one was this point about if we accept that all this is true, won't it all get out of control, and we may not get hyperinflation, but won't we create some kind of stagflation like the 70s or something like that? Has Vince tackled them to your satisfaction?
The second question on the sectoral balances, the reason why that the sectoral balances or should make sense is because the private sector has no capacity to create its own money. So that's why those balances are mirror images of each other, because it's the central government that actually creates the money, and the central government spends that money into the economy through wages, through public sector services, through however it spends, and by definition that has to go somewhere, and the only place for it to go is either on imports, leaves country, or it goes into somebody's bank account. It goes into an account somewhere. It goes to the financial sector, or it goes to the corporate sector, or it goes to households. And the last one on hyperinflation, I think I did discuss that, but I can't see that. I kind of use the Jack Nicholson analogy where you can't handle the truth, and that is really that's really the reasoning behind it, because they don't think that the population or the population at large is capable of handling that. And I've got a couple of quotes towards the end of the presentation that I think are more kind of formalized that some economists have put forward as to why this is necessary.
So on that question about if the government's got the printing press and we're going to get inflation, all the rest of it, given that 97%, I think you were saying, of the of the money supply is actually commercial bank loans,
No, it's
then
not. No, 97% is deposits. So when the government spends, all government spending, all 100% of government spending will show up in deposits somewhere, because the government uses the commercial banking sector to get money. So when, okay, we'll take, £100 getting paid by a pension. The government will create £100. The Bank of England will create £100. They then will spend it into the commercial banks via reserves, and they will pay Mrs. Smith £100, and that will show up as a deposit. So 97% are deposits, and that deposit base is bank loans. So when the bank makes a mortgage, they also give you a deposit, right? Or if you get a consumer loan, I borrow £5,000 from the bank, that shows as a deposit. So that's also a deposit. So central government money shows up as deposits, and bank loans show up as deposits. Now, what I don't have is a precise breakdown of that 97%, which is government and which is bank loans. But I do know that the majority is bank loans.
Yeah, which was sort of where I was going, in the if that's the case and the majority is bank loans, then it's far more likely that inflation is sourced via commercial bank lending than it is from money creation by the government.
I would say, I think a wonderful example would be the real estate market, housing market. Let's see what happens when we allow enormous amounts of money to be created for one asset of limited, finite supply. I think that's a beautiful example. So all of the talk around planning permission and everything else, I was talking to somebody about this the other day. We used to have laws that restricted bank lending to 3.5 to 4 times salary. And I remember when interest rates started to fall, the banks realized that they couldn't lend anymore, because at 4 to 4.5 times, people were at that limit, So what they started to argue for was an affordability metric. And they said, now we don't need to worry about these meddlesome income ratios. We just look at affordability, which of course, as interest rates fell, people's ability to borrow and the affordability metric look much better, which is, and I remember at the time thinking, but what happens when interest rates rise? It took a number of years for that to happen, but we're seeing in glorious Technicolor now, what could happen. This all could have been prevented by just restricting it to 3.5 to 4 times, even as interest rates came down to 0. And then it would have been functionally impossible for the housing market to do what it did. Because I think in London now, it's like over 10 times earnings. And for the majority of the country at large, it's somewhere around 6 times, I think, or 6.5 times. So, this is all, that's a wonderful example of inflation, but it had nothing to do with government money creation. It was all mortgages.
Yeah, and then if you got
with commercial, with central government spending, is it's so diffuse. That money is spent across the country, across different sectors, health service, defense, all over. And it's far less likely to be inflationary than something like, the London housing market, where, there was obscene amounts of money going into over the last 10 years or so.
Right, and the commercial banks have got every incentive to just keep lending, because pretty much every loan is going to be profitable apart from the bad loans. So it's just a case of pump it up.
I don't know if you saw recently, but there was a piece in the papers about the Bank of England said that they're concerned about 35-year mortgages now. So the banks have now realized that, obviously, given valuations, the old mortgage terms are no longer affordable. So there's more and more of these 35-year mortgages. What I don't understand is, rather than the Bank of England saying we're concerned, why don't they just regulate? Because this is going to be another, problem in X years' time, that the next generation of central bankers and people are going to have to deal with, which for me is personally really frustrating. But yeah, that's the financial sector in this country is so strong, it's very difficult to kind of rein them in.
Yep. Thanks.
And there are a couple of questions in the chat. One from Lynn Jones, who says, I'm interested in the green lines, which, if I remember, that was the foreign surplus. I noticed that in 2022, our government deficit was 5%, but private and imports totaled 7%. Please explain.
Oh, I'd have to go back. I need to go back to my numbers on that. Let me come back to you, Lynn, on that.
And the other question was from Tony, who says, with this idea that money is scarce, government money is scarce, is it willfully ideological or ignorance on politicians' part?
I think it's both. My guess, and I've spoken to other people, my guess is that a lot of it is ignorance. But I think I was speaking to a former MP, and I asked him the question. You know, he was MP for a Labour seat, and we were talking about the household analogy, and I asked him why, you know, did he ever at any point feel the desire to explain to his constituents about how money works, and how government is not like a household, and that they really should be pushing back on why their services were, their local services were being destroyed, and their services were being underfunded. And he said it was easier for him to explain it in terms of a household than get into the intricacies of anything like we're doing here, which I thought was deeply depressing. So I think it's a mixture of lack of confidence in being able to talk about it, ignorance, and certainly ideological. Because if you are of a certain ideological bent, you have to convince people that money is scarce, because your entire ideology is dependent on that. If you want to shrink the state, you have to convince people that the state needs shrinking. So that is critical, that you maintain this lie. So I think it's for lots of reasons. But I think if you take something like a wealth tax, if you understand how money is created, and you understand the role of taxes, you'd also understand that there's no need for a wealth tax, certainly not to provision the state. So whenever I read somebody on the left saying that to fund the NHS, or to fund this, or to fund that, we need wealth taxes, or we need this tax, and I just think that's so counterproductive. I mean, it's very seductive, and it makes a great soundbite, and lots of people will agree with it. And in fact, if you take a wealth tax, there are many reasons why we need a wealth tax. But the one that we don't need is to provision the government. There's all sorts of inequality issues. There's been numerous studies on how inequality is corrosive to every society, going back to Roman times or even Egyptian times. When inequality gets too big, societies fracture and bad things happen. So there's plenty of reasons for us to discuss a wealth tax, but it is not to fund the government. And I think that's really counterproductive as well. So I think both on the left and the right, there are reasons why people talk this way, and it just makes it really difficult to actually get the truth across.
One extra question has come into the chat. Labour doesn't want to shrink the state, so why don't they want to create money?
Because they don't want to frighten people. When 95% of people deny the fact that governments can create money, for anybody to challenge that, it runs the risk of ridicule and misunderstanding. Imagine them announcing something like this and having to convince the entire population between now and the next election that we can do way more than we're actually doing right now. I mean, that I think would be a suicide mission. The right-wing press would have a field day. Most people are ignorant of how money's created. A lot of people will go directly to the Weimar Republic analogy, and Labour would lose all credibility on the economy. So I think this is something that needs to be done over time. I'm still thinking about how to, drive this debate forward respectfully to try and get more people involved. But I can totally understand why Labour wouldn't do it. It'd be electoral suicide. Interestingly enough, the BBC, I'll send that around as well when we send the presentation, but the BBC had a commission last year about their portrayal of economics. And one of the specific criticisms was the fact that the BBC too often, when they were speaking about the economy, talked about the government, they talked about the government as a household. And they were specifically criticized for that. So there's widespread acknowledgement that that this is a problem, but it seems that it's only really the BBC that's taken any kind of formal action. So indeed, if you see anything written in the BBC that references central government as needing taxpayers' money, or if they're talking about the government as a household, and I actually spoke to a BBC journalist, and he told me, he said, write in, if you send something into the BBC, it has to be investigated. They have to respond to you, and hopefully, the more people that write in complaining about how they cover these issues, maybe it will at least start to make a difference with somebody like the BBC. Obviously, the private sector press, there's nothing we can do. Yes, and it was actually Andy Verity who I spoke to about this, Howard. So I spoke to Andy in September, and we were talking about this point, and he said, so I'm thinking of putting together a template and putting it online so that people can just go to the website and it will send an automated email to the BBC to complain, to make it really easy for people, so that we can start pushing back.
And there's a question from Tony, which I think is a very interesting one. He says, with such a difficult concept, despite being theoretically sound, would a limited simulation be possible to create money and tax back if inflation occurs? A trial run for people to see the thing in practice, rather than a huge untried risk factor.
I would love to see this. And I thought this would be a great way to illustrate the concept. And I've been thinking about ways that it could be done practically. But obviously, this is such a sea change in attitude. I'm not saying, in fact, it would be insane for any government to adopt this, to get from where we are today to where we could be. There's a long way to go, not least the fact that every other Western government continues to believe that and pretends the lie as well. So, the UK is not a very large economy in a global sense. And for the UK to suddenly decide that we're going to do things completely different also has a number of issues attached to it. But none of them insurmountable. But I think a limited trial in some way would be really interesting, and illustrate the concept. And of course, even on a large scale, if inflation occurs, you raise taxes. But I think the difference, if we were to have a situation due to excessive government spending, people would have the money. So the problem that we have today is people don't have the money. Taxes are being raised, interest rates are being raised for reasons beyond their control. So they already have reduced spending power, and now you have governments reducing their spending power more via raising interest rates, and then reducing it more via taxation. Whereas if it was as straightforward as people just having too many pounds, it wouldn't be nearly as painful if the government was to just obviously you would hope that it would be targeted at the right sectors that had the surplus of pounds, but that's another question. But I don't see a problem there. So what sort of limited trial? A regional trial, maybe via local authority, a local government. Maybe a national trial of a limited demographic, potentially. I don't know. I mean, I think there's a number of things that we could do, but I think that could be an interesting one. Maybe publish the full balance sheet. Well, I said at the beginning, we should have had a set of national accounts by now. The government had said back in 2018 or 2019 that they were going to publish a full balance sheet. They haven't done so yet. So on to the false choices we are offered. So, when we think about increasing public spending in a particular area, most people think that we must raise taxes, as I said, or cut public spending somewhere else, or disregard self-imposed spending rules. And that's simply not the case. So what are, the real constraints? The primary spending constraint is inflation. So, I keep mentioning inflation. That is the key restraint that we have. And as Alan Greenspan said, by extension, the productive output of the economy. if we accept that the central government can create money in unlimited quantities, we need that same central government needs to ensure that there is adequate goods and services to be purchased with that created money. Otherwise, you're going to have inflation. Like there's no other alternative. So really, what the government needs to be focusing on is how do we build up that productive capacity, and that is something I rarely hear. We always seem to stop at the money, which is actually absolutely the wrong discussion that we should be having. So if there's insufficient capacity in relation to demand, then additional spending will do nothing but raise prices. So really the key thing here is real resources, it's real output, and ensuring that these tokens, this money, this token stuff that the government creates, that it has some value by the goods and services that, the real goods and services that it can purchase. So, the government can and must add to the demand side of the economy via spending, which is what they do. But in order to allow for this, they must also add to the productive capacity of the economy, which we really don't talk enough about. That's really what we need to be focusing on. And I think a great example of this was, I think, last year when the Chancellor mentioned a multi-billion-pound plan to expand free childcare. And I remember seeing this on the budget, and there was widespread recognition that people were struggling, women in particular were struggling to get back to work because of the, inadequate and insufficient childcare. So the government thought, well, we can give a sop of a few £1 billion and we'll get some good press and everything will be fixed. And immediately the next day, the local government association came out and said, well, hang on a minute, we don't have the capacity. So you can spend as much as you like on, 2 billion, 3 billion, 5 billion into this scheme. But if we physically don't have the places, it doesn't matter how much money you put in. And in fact, all you're going to do, if that money is specifically targeted, is you're going to raise the price because there's a finite capacity and you're now injecting additional spending power for that particular use. You're going to have inflation. So that to me was economic incompetence. And that was like not understanding. I'm sure he did understand, but he was just really looking for the soundbite. But that was a great example of not understanding how things work. If he was serious, he should have been talking about increasing capacity first. What do I need to do to encourage capacity either via public sector or private sector? And then when we have that capacity, then give the multi-billion-pound giveaway so that then people then have the money to then use that capacity. So he actually did it the wrong way around. But I thought that was a really interesting one. So we talked a lot about this, why do they do this? Why the lie? And this was written actually just after the Bretton Woods system broke down in 1971. I think that there is an element of truth in the view that the superstition that the budget must be balanced at all time and is necessary. Once it is debunked, it takes away one of the bulwarks that every society must have against expenditure, and I guess therefore inflation, out of control. There must be discipline in the allocation of resources, or you will have an anarchistic chaos and inefficiency. And one of the functions of old-fashioned religion was to scare people sometimes by what might be regarded as the myths into behaving in a way that the long-run civilized life requires. I have to say I see merit in that view. And that was written by Paul Samuelson not long after the end of the Bretton Woods. And I think this really, this is a great kind of insight into, what the established economic profession thinks as to why, we need to this myth, because basically we can't handle the truth. And, people at large, would demand so much that we would have expenditure out of control, which of course is nonsense if you have the right guardrails in place, which we actually have. Like I said, the Bank of England 2%. So the reality, to finish up, is no debt crisis, not today, not on the horizon. The national debt poses no risk to our nation's finances. The so-called debt is just the pounds that the government spent but didn't tax back. The national debt is just part of the broader UK money supply. It will not leave future generations with a lower standard of living or a crushing burden of debt and taxes. It's nothing like running up your personal credit card, and we do not need to eventually pay it off. So I think, you know, these would be the key takeaways. And anybody that tells you differently, you know, is being untruthful. You know, the government debt, when the government debt is repaid, it's going to be repaid with more government debt. And as we've seen, maybe I do another session on quantitative easing. Even if we think that there's insufficient purchasing power in the economy at present, we just credit them with reserves, the commercial banks with reserves, and then they buy the debt. So, you know, there's never a situation where the government cannot sell the debt. And this is assuming that we continue with the fiction that, or, you know, the self-imposed constraint that the central government balances at the Bank of England can't be negative. So, you know, the questions we should be asking, you know, what does our country need? What are our collective priorities? What policies need to be put in place to ensure that our economy has a productive capacity, educated and healthy workforce, infrastructure, and all the other things to provide for those priorities? You know, and why are politicians of all stripes allowed to constantly reinforce the lie that we need to find the money to enact a certain policy? You know, we should be demanding, you know, how do we resource the policies that we want to see, and then vote for those politicians who we think are most likely to promote those policies that will achieve our aims and desires. And, you know, I think that's really it. You know, to finish off here, this isn't a presentation on MMT. I think one of the emails I had, you know, is this modern monetary theory? I've deliberately shied away from anything modern monetary theory related. You know, I have a book here if anybody's interested on modern monetary theory. If they want to understand the economics and some of the policies behind it, none of that is in here. What MMT, or what the modern monetary theorists did do, is they shined a light on how this actually works. And no other group of economists have done this. No other central bank has done this. And I think the great thing that they have done, you know, their economic policies, we can debate all night. But I think one credit that they've done to everybody is they've actually done a lot of work on presenting actually how things work, which then allows all sorts of different economic possibilities, all sorts of different theories, and all sorts of different things that, you know, that we can look at. And for this particular tweet here, Rupert Harrison was he was George Osborne's special advisor, and he was one of the architects of austerity. And, you know, this is the sort of thing that, you know, you come up against all the time if you have an interest in something like this. So Andy Verity said, you know, as long as we labor under the delusion that financial choices are the same for a government as they are for a household who don't have a bank or money printing machines, we'll be having the wrong conversations. And Rupert came back. You know, this is a BBC economics journalist expressing fringe economic views, essentially pure MMT that have been tested to destruction. And you know, all he's saying is the truth here. You know, this should really be non-controversial. This should be apolitical, because it's not dependent on your politics as to how governments spend, how the government accounting works. Again, I'm happy to do another workshop going through all the double entry for all the different accounts so we can look at all the different money flows. That's really interesting and instructive as well. Totally apolitical. You know, it frankly should not even be discussed in those terms. So the cost of a lie. So this, you know, there are real costs. So, you know, I think we all have our own examples. I've got a few here. You know, we're not funding the NHS properly. 340,000 people died awaiting treatment. You know, 1 in 4 teachers gave food to hungry pupils. Labour pushes back on their Green New Deal. We've got the crumbling school buildings. And, you know, yesterday I saw, you know, HS2 won't go to Euston because apparently the government doesn't have enough money to actually finish it from North London to Euston. So future generations will never have that asset of a high-speed train because of the myth that, you know, we simply don't have enough money, which is you know, it's awful and it's totally unnecessary. I wanted to just throw these last couple of charts in here, which really I found deeply depressing. But, you know, when you have a system that refuses to acknowledge that central governments can create money, almost by definition, you're going to have insufficient investment spending because the governments don't have enough money. So what we have here, this is actually from the Office of National Statistics. It's where I got it from the website there. And it's got the productivity, which is very closely linked to investments. And you can see in red here, this is the UK region. So we've got London, which is unsurprisingly way out there. And so the UK as a whole is at 100. And I thought one of the really shocking and sad statistics is you can see that most of the UK is right down at the bottom here. And, you know, as long as we continue to insist that the government has no money, we can't spend money on infrastructure, we can't spend money on education, we can't, you know, leveling up, which was a complete lie, you know, we're going to be languishing down here. And what I found particularly depressing is that these four gray bars here are actually the former East German regions in Germany. So, you know, we're competing with ex-communist countries. You know, these were the ex-industrial regions in the old East Germany. And, you know, it really is depressing for a country like Great Britain that we find ourselves here because we insist that we have no money. Here we've got, you know, the future. We can change all this. You know, the difficulty, and John Maynard Keynes came out with a great quote here, you know, the difficulty lies not so much in developing new ideas as in escaping from old ones. You know, one thing that the UK has been, you know, the US and the UK have been followers of a particular economic regime. The US has had far more flexibility given its size and the fact that it's you know, it's got the reserve currency and it's got a massive market and everything. But, you know, I think the UK has been really punished with the road that we've traveled down the last 30 years. And I think that last chart goes some way to highlighting that. You know, once we allow ourselves to be disobedient to the test of an accountant's profit, you know, we will have begun to change our civilization. So, you know, we do have the resources to begin repairing our broken system, and we've got to believe it's possible. And one thing that I find, again, you know, quite depressing is when I speak to a lot of people, they just feel that we can't do it. You know, they feel, I was speaking to a friend of mine recently, and she's in her 40s, and she says, when I talk to my friends, we think that we're the last generation that really had a good life in the UK, which is utter nonsense. You know, we can change this. You know, we have the resources, we have the real resources, we have the human resources, and we certainly have the money, as I've highlighted here. We have these spending tokens. It's a question of pulling everything together and you know, making everything work. And anybody that's interested, you know, Marina Mazzucato has done some fantastic work on this as well, you know, on some ideas that we can do in terms of industrial policy. So, you know, we can't let a misunderstanding of words like debt and deficits hold us back. You know, the national debt is nothing other than untaxed government spending. Deficits are nothing more than private sector surpluses. It's as simple as that. With a better understanding of public money, where it comes from, how it works, then we can start to fix some of the you know, very real deficits that we see all around us today. And, you know, the real deficits we have aren't the financial ones. You know, there are health deficits, education deficits, infrastructure deficits, good job deficits, you know, not the fictional financial ones. So that's it. That's the end. So on to the final Q&A. And if anybody has any questions.
From JW saying, all this applies to us in the UK. Is it different for other countries, i.e. non-sovereign currencies? So, for example, Greece and Italy. And
yeah, absolutely. You know, the problem with Greece is they found, and Italy and Spain and, you know, Ireland and Portugal, is the fact that they can't create money. So, you know, they're constrained. They have numeric constraints on their deficits. And if they go over a certain deficit, they're punished. Or, you know, effectively, you know, Italy was severely punished when they dared to suggest that they were going to go through their deficit targets, the agreed deficit. So the European Central Bank effectively stepped back and let the Italian government bond spreads explode, and which then forced out, I think Berlusconi was there at the time, he left, and we had a technocrat in, and he said that, you know, we will implement austerity, and you know, we will ensure that we adhere to the European Union laws. So if you borrowed a different currency, if you're in Argentina, if you're Venezuela, if you're you know, most of the emerging markets, because there's so little credibility in their domestic currencies, they're forced to borrow in US dollars. They can't do any of this because fundamentally they have to find the dollars. Like at all times, they need to find their dollars because they need to repay their debt. And if their currency depreciates too much, they're unable to do that. And that's why we've had multiple, emerging market debt crises over the last kind of 30 or 40 years. The UK is not in that situation because we only issue in pounds. We have no foreign currency debt here in the UK.
I hope this isn't too far off the course, as it were. But I was intrigued at the last few remarks of the speaker, where we're talking about the productive output of the economy. Now, there's a nice little book by, I think it's Diane Coyle, called A Short and Affectionate History of GDP, which makes the point that public services provision are defined in terms of GDP as being the cost or the expenditure that they make in a particular year. Now, that seems on the surface quite sensible. But if you take the health service, which is my background, if, for example, a hospital increased its throughput by a third with the same amount of money in the second year than it had in the first year, then none of that shows up because it's still spending the same amount of cash. And I think one of the problems we have in the UK is that we don't really have a clear understanding of what the different parts of the public service are there to do, and how that in turn contributes to the overall gross domestic product of the United Kingdom. Is this an immutable part of economics that whatever we do, we can't shift?
Well, I think there's been a number of attempts. GDP, as Diane Coyle's book illustrates so wonderfully, is a terrible measure. Even the creator of GDP warned against using it as a measure of societal well-being. He recognized when GDP briefly, the metric GDP was developed because back in the 30s, because the government needed to know how many tanks can we make, how many bombs can we make, and we needed to know what the productive output was for war. Simon Kuznets, who created GDP, actually warned against using this as a measure of societal well-being. There's been a lot of measures. Joe Stiglitz has tried a couple of times. I think he worked with Emmanuel Macron in France, and he worked with the Mexican government to come up with an alternative measure to GDP. It wasn't adopted. I don't have an answer to that question. I think it would be great if we could come up with an alternative measure that more accurately measures, a better measure of society. And I've actually thought at various times of thinking about some kind of a dashboard that we could put together, taking particular metrics that would be more illustrative of the performance of an economy. But for now, the IMF uses it, the OECD uses it, all the major Western economies use it. I think it's very difficult. Of course, what we could do is we could provide an alternative set of accounts, and maybe that's something that would be interesting to push for. But I think we could certainly do a better job. But I don't see it. I don't really see anybody working on this, certainly, on the political side.
One observation and one question. So on the problem of trying to convince the population of, the common sense of this way to look at things, I think a lot of psychology needs to be factored in, because for most people, money is a survival level importance, and they believe it's real. It is what it is, and of course, what, is really the case is that it isn't really real. It isn't a real thing. It's a promise of value and all this. So if you start trying to combat people's visceral emotions about their survival in terms of money, if you try to combat that with sensible facts, in a normal conversation, then it isn't going to work. You're just going to annoy people at least. So that's my observation about the problem, and that the psychology of how to get the message across needs to be really looked at. And my question is, someone said in the chat, didn't Jeremy Corbyn prepare the ground enough? And my question is, had Jeremy Corbyn become Prime Minister, would he have had the kind of reaction Liz Truss had? You know, would the banking establishment have just panicked and gone, what? And he would have been kicked out. So that's my question. Thank you.
Yeah, that's a tricky one. I think I think Jeremy Corbyn was probably too ideological. You know, what we're talking about here is completely not ideological. You don't you know, I would argue, you know, I think it needs to come from somebody without an obvious agenda. And I think if Jeremy Corbyn would have tried something like this, he would have failed. Talking about Liz Truss, you know, the problem that Liz Truss had was that she didn't coordinate with the Bank of England. You know, none of that needed happening. None of that needed to happen. The fact that they made a point. They fired the Treasury, one of the main liaisons between Number 11 and the Bank of England, right? Kwasi Kwarteng fired him. You know, they were deliberate in their kind of disdain for anybody's opinion. And of course, when everything started to go wrong, the Bank of England and the government weren't communicating initially, and that's why we had this panic. I mean, you know, if you look at something like, if you look at Japan, you know, Japan has you know, run the largest deficits in the developed world for a number of years, and they've kept interest rates near zero. You know, government bond rates. And, you know, what they've said is, you know, if the government says they want interest rates at here, then the Bank of Japan will buy however many bonds to maintain that level. And our bank could have done the same thing. There was no need for the panic that we saw with the Liz Truss thing. I think there was a lot going on behind the scenes. You know, the markets are in no way bigger than a central bank, because the markets are always on the private sector side. They always have to find the money. You know, the central banks can buy as many, you know, the central banks could buy the entirety of the UK government debt if they wanted to. There's nothing preventing them doing that, other than, you know, there's probably some technical issues, but, you know, in theory, there's nothing to prevent them from doing that. On the psychology side, I agree. And that is one of the big problems we have. You know, when people have been steeped in this lie for so long, it's going to be very, very difficult. I think it's doable. I think if there was a brave enough politician who could start to talk about these things. But I fear that as soon as you open your mouth with something like this, people you know, certainly the right-wing press will immediately go to hyperinflation and, you know, all this crazy MMT stuff. So it's going to be really challenging, because ultimately there are some very powerful interests that do not want people to understand money. And, you know, that's the other thing. The financial sector do not want you to understand